Listen to AM 560 The Answer online at 560theanswer.com, on the AM 560 mobile app, on your Alexa-powered smart speaker, and on TuneIn, iHeart, and on Odyssey. Now, from the Signature Bank Studios, this is Chicago's Morning Answer with Dan Proft and Amy Jacobson on AM 560 The Answer.
Top of the morning, Dan and Amy. So the June jobs report is out. Job market adding 209,000 jobs in the month of June. U.S. employers now adding jobs for 30 consecutive months. But that was below street expectations of 225,000 jobs. So does that mean the market's cooling off and the Fed will cool off raising interest rates? For more on that question and other market-related matters, pleased to be joined by James Perry, founder, CIO of Perry International Capital Partners, LLC. Jim, thanks for joining us. Appreciate it.
Good morning, Dan. Good morning, Amy.
Morning. So what about the impact of this jobs number?
Job growth has been better than expected, yet really job growth remains fairly muted. The economy, Dan, is probably slated to grow at 1% this year. That's the Fed forecast by the fourth quarter, maybe even a little recession. And at the same time, inflation is running at 4.5% and rising. So that's a stagflation environment. It's the same one we've been in for 18 months. This payroll number really doesn't change that much.
So we're just going to hold. So then, what? Before we get to sort of the macro question, so what does the Fed do this month with respect to rates?
Oh, they're going to hike. They should have done it last month. The biggest problem for the Fed and the central banks of the other Western democracies, the ECB, the Bank of England, Canada, Australia. In Europe, there's officially a recession, and the ECB is tightening. And Australia, Canada, Norway, countless other firms. I sent a report out on July 4th. There's 2 or 3 central banks on the planet that are easing, and their countries are going through a recession, which is, basically China and Japan. Everybody else is hiking because inflation is much higher than expected and rising.
Okay, so another 25 basis point hike in July?
Yes, sir. I think that gets you to about 5.5% upper bound, and I would suspect that by the end of the year, the Fed funds rate will be closer to 6% than 5%. There will be no rate cuts this year.
Well, when will we be going into our recession?
Not happening. I read your newsletter. It's not happening, right, Jim?
Right. Big parts of the economy are struggling mightily, but the biggest problem is, and Amy, to your point, there has not been a recession as many of the masters of the universe have proclaimed. And I think what they've missed really is liquidity, right? I'm a global macro guy, and if you look at money supply and stock market indices correlate quite highly. And liquidity really is a function of government stimulus, and we've gotten a lot of it. I mean, the bigger picture is the pandemic stimulus, which was, from the last financial recession in 2009 to sort of now, the Fed's balance sheet increased by a factor of 10, right? That's $800 billion up to $8 trillion. That's incredible. And $5 trillion of it was money that was printed to combat the pandemic slowdown. So over the last 3 years, the Fed's balance sheet increased by 50%. That's monetary stimulus. That's still with us. A lot of people say, well, stock market's got to go down because money supply is collapsing. That's true on a short-term basis. It's come down really, really hard from being up as high as it was 2 years ago. But if you look at long-term trends, money supply is still trending well above average. There's a ton of liquidity in the financial system still.
So you still,
why the stock market can just go well.
Right. So, and this is not just asset purchases by the Fed. What some of the masters of the universe, as you were saying, what they missed is, A few hundred billion here and a couple of trillion there in the semiconductor sector for
Right.
infrastructure around the country for public sector unions and the trades, as well as for these alternate energy companies. Well, you just added a couple few $1 trillion more of funny money from the federal government. So that has a sustaining impact as well.
Absolutely. I mean, the stock market's been rallying since October, right? And that's because of three massive liquidity infusions. The regional central bank crisis, that the Fed's balance sheet went up by $600 billion, right? So that started the rally back in October. And then, most recently, busting through this debt ceiling legislation, this increased national debt by $2.5 trillion, right? This is fiscal stimulus. This is pandemic emergency spending, which is supposed to be rolled back, yet it's been locked in for another 2 years at least, right? This is $2.5 trillion of fiscal stimulus by the government to spend on whatever they deem is an appropriate area of the economy to invest in.
So
whether it be,
so the big guy was right. The big guy was right. We need to keep spending in order to prevent from going bankrupt.
As long as you don't have to pay for it. Yeah, government now these days, you talk to progressive people and they say, everything's free. Money, debt doesn't matter. You can just write it off. As long as you can pay your bills, you can just keep spending. And I don't know where that comes from. It's not the way I run my household. But, it's a tremendous amount of money that's being spent by the government, and only government can create inflation. And they're creating more of it, Dan, now than they were, in the midst of the pandemic, right?
Well,
and the pandemic's over. The economy's booming. So you've got trillions, not just hundreds of billions, but trillions of dollars of money in the economy that is pushing job growth higher. And this is the biggest imbalance that the Fed's worried about, right? We've heard this from Powell, for months and months. There's a massive imbalance in the labor market, which is causing wages to rise, especially in the service sector. And because of that, service sector prices are continuing to go up because people have to spend money on labor to keep their businesses open.
well, why don't we, the unspent COVID money, why don't they return that to the Treasury?
The government's going to give back money? Amy.
Well, they could make news by doing it.
Yeah, that's never happened and never will. The one thing that's sort of interesting, that's slightly esoteric to your point, is that, when we had this debt ceiling sort of impasse, what happened was the U.S. Treasury used about $600 billion in what they call the Treasury General Account, the TGA. That's a balance to pay its bills, which when they were forced to postpone, this $850 billion in bond issuance. So the Treasury General Account is down to $30 billion. So that $600 billion, that Treasury General Account has to be refilled, right? So that $600 billion was stimulus, and now it has to be refilled. So that is coming out of the market. That's over now, right? And the other thing is the Fed's balance sheet is beginning to get back down to where it was before the bank crisis. So you're kind of at an interesting inflection point that, the stimulus that we've gotten over the last 12 months, and certainly the last 6 or 9, is over. So it appears to me, if you just look at valuation metrics and recognizing that we're still in an earnings recession, even with the big magnificent seven, Microsoft and Apple, these revenues of these big companies, I think Microsoft's revenues have gone down 5 quarters in a row, right? So you're having an earnings recession, even with the best performing stocks, and they're selling at multiples that we haven't seen since the dot-com boom, So the stock market's overvalued, but, everybody still thinks we're going to the moon here, I guess.
Yeah. So the market's overvalued. It's being buoyed by a small percentage of big tech and AI, tech-related companies, and yet it's still on green.
Yeah, I mean, it is, and again, sometimes they always say averages hide more than they reveal. So we get these averages on TV, and it doesn't really tell us a lot. But what I think is interesting is that, you look at this sort of level of private wealth in this country. It's $148.5 trillion, right? That's up $2.5 trillion from the first quarter of this year, right? That's $2.5 trillion. So people who have savings and have real estate and own things, pensions, IRAs, mutual funds, homes, they feel like this is a bull market, and they're spending money. And it's really helping the service sector of the economy. I mean, I don't know the last time you've been on a plane, but every single flight I'm on in the last 2 months is overbooked. I hear the cruise ships are all overbooked in Miami. Every restaurant and hotel in Chicago, Washington, D.C. I was in, New York. You can't get a reservation. So at the high end, people who have money don't mind that prices are rising at 5 and 10 and 15 and 20% a year. But the people that are making, the average income, just a little bit of above average income, 75 grand, 100 grand a year, these households are getting hammered. Discretionary spending and disposable household income numbers, they're negative, right? So people are diving into their. Sorry, go ahead.
Yeah, well, so then how does an overvalue market continue to build on its overvaluation? I mean, doesn't there have to be some regression to the mean?
Yeah, I think so. I mean, I think as people see the liquidity draining from the larger system, it will come out. And the other thing that's changing, I mean, and Amy, we've talked about this housing. Look at housing. It's so expensive, and mortgage rates are now 7.25% almost, right?
Yeah.
Dan, we talked about this 6 months ago, and I said I think mortgages are going to go over 7%. The Fed's going to keep going here. Housing affordability has never been worse for the new home buyer, right? The first-time home buyer. Existing home sales are falling. People are locked into low mortgages from 2 and 3 years ago and 5 years ago. They don't want to sell. So the housing market is really changing. Existing homes is usually something like 85% of the housing market. And new home sales were like 10, and 12. New home sales are 30% of the housing market right now, right? Because the builders are giving incentives to people and zero financing to move product, and they're cutting costs. But there's a shortage of housing, and this is why rents, especially for kids just starting out of college, second job, third job, 5 years out of college, 30-year-olds, the rents that they have to pay in the cities that they work in, and it's everyone, even San Francisco, right? San Francisco, L.A., New York, Chicago, rents are up 20%. In New York, 10%, 20% in Miami. The housing market's not going down in Florida at all. And the other thing is, this is important. So these kids are spending more and more of their income on shelter. Shelter is 40% of CPI, right, after food and energy. So CPI is rising. Wages are going up and rent payments are going up. So the fact is that disposable incomes are going down and people are spending more money, and they'll quit doing it when all of a sudden they feel less wealthy than they are.
Well,
the good thing is
to feel less wealthy than they feel now, the equity markets are going to have to start mirroring the economy in terms of that. Yeah,
Right.
as you were describing, the stagflationary environment, slow growth. So,
Yeah.
so how does that contradiction resolve itself? In which direction do you think the market just continues to relentlessly rebound regardless of the slowing economy?
I think that the average consumer has been emboldened by the equity market. They feel like, punting around on options on Tesla makes up for things. The cost of money really is not that prohibitive, not prohibitive enough to slow demand. The economy has not slowed enough to increase unemployment. I mean, the unemployment rate today went back down to 3.6%, right? So people are starting to go back to work, and they're quitting their jobs less. But I think what really changes is going to be the Fed. I mean, the Fed has said for a long time that rates are going to go higher, and interest rates aren't prohibitive enough to slow the economy. So I think you're going to see, maybe it's an every other month or every month. We'll know more, in July when the Fed moves again. It's on the 26th. But I think what's going to happen is I think the stock market, Dan, probably continues to rise marginally, different sectors, little rotations. And the Fed will keep hiking until the stock market tells it not to.
And then the politicians in D.C. will try to get together to figure out how they can achieve some compromise to spend more to prop that up in the face of rate hikes, right?
Yeah, this is right to their playbook. I mean, they want a financial crisis so that the government can step in again and say, "Don't worry, we'll protect you and give you another stimulus package." This is the agenda of big government. Keep growing because you can,
James Perry, founder, CIO, Perry International Capital Partners, LLC. Jim, thanks as always. Appreciate it.
Dan, thank you. Have a good weekend.
Thanks, you too. And he joined us on our turnkey.pro answer line.
The more you listen, the more you'll know. This is Chicago.